afternoon. I'm Rishi here from the FSM1 Investment Marketing team. So before I introduce our speaker for today, please allow me to make several announcements. So first of all, for those who are joining the webinar now, please mute your mic, okay, so that you can experience we can have a better audio experience. Also, we will temporarily close the chat room. Okay, and we will resume it back during the Q&A session after the presentation. So if you have any questions, feel free to type them in the chat room during the Q&A session. Okay, so throughout the webinar session, if you're experiencing any audio issue, you can try to rejoin the webinar. Okay, some of you may ask, how do you mute the mic? So below the screen, you will see 4 icons. So the first icon is the mic icon. So if it's red color, means it's muted. If it's green color, means you have unmute your mic, and I would appreciate if you can mute it. Okay, so with that, allow me to give a brief introduction of the speaker for today, Mr. Patrick Chung. He is the CIO of Principal Asset Management Berhad. Patrick brings with him over 19 years of extensive asset management experience, and he manages the investment team in Malaysia. He was previously the head of ASEAN Equities at BNP Paribas Investment Partners, where he was overseeing the ASEAN equities for both Malaysia and also offshore clients from 2012. Prior to that, Patrick also served as Senior VP for CIMB Principal Asset Management, where he specialized in ASEAN and also specialist Asia ex-Japan funds. Okay, so he graduated with a Master of Science Finance from City University Business School and also had a Bachelor of Science Accounting and Financial Analysis from University of Warwick, UK. So with that, I will pass the mic to Patrick to proceed with his presentation. Patrick?
Hi, good afternoon, everyone. Thank you very much. First and foremost, on behalf of Principal Asset Management, I would like to thank all of you for joining us on this webinar. I also like to take this opportunity to thank IFAS to give us the opportunity to do this webinar. I think it's a very good initiative and probably one of many to come. And also for those of you who have been big supporters of Principal Asset Management, thank you very much on behalf of management and myself. I hope of those who have not been invested with us after this, you know what to do. And that you are more than happy to engage with us in the future to talk more about investments. So today, I want to talk about my favorite topic, and that is on China. And the reason why we want to talk about China is because China is a fascinating market, as you know, fascinating country, but more importantly, a very fascinating investment destination for investors like ourselves, as well as yourself, today and tomorrow. Our theme for today is to talk a little bit about what China is during the COVID crisis, what China will be and it was going to be in the future, and we'll talk about some of the themes I'll talk about, and what kind of measures they have put in place for them to sustain its growth over the next years or decades to come. And so I want to talk a little bit about where the COVID situation is first. And if you move to the next slide, please, right? And so first and foremost, right, I want to declare this very upfront, right? We are in no way COVID-19 scientists or analysts. And I don't profess to know what is really going to happen in the future. But what I do know currently is the data suggests that cases in China have declined, and the cases outside of China have started, depending on which market you invest in, especially in the US, have started to rise. And so when you look at this particular chart here, it gives you a sense that China has done a lot of many things that has improved its current situation, right? So if you were to backtrack a little bit, beginning of January, number of cases started to rise, and that's your yellow line there. And it started to spike tremendously up until middle of February. And because of a lot of measures put in place by the Chinese government, especially in Wuhan, we started to see the implementation of this very, very effectively, and the number of cases have started to decline. I was just checking Bloomberg just now, and safe to say, after about close to almost 2.5 months or 3 months of lockdown, Wuhan, for the very first time, has opened up Wuhan itself, and everybody is very happy to get out of Wuhan now, right? But jokes aside, China is actually improving, right? And also because I think the other key point here is that China has used, key point number 4 is that has used technology actually to trace its COVID cases, and as a result of that, I think that has been a very major improvement in the number of new cases. Moving on to the next slide, you can see here, next slide. You can see here, as I was telling you earlier on, how the COVID cases has evolved over time. Unfortunately, the United States is starting to rise very, very rapidly. The last count I've checked on data is about 392,000 new cases, and it's developing as we speak. Obviously, the biggest epicenter of this is New York and New Jersey. Hopefully, things will start to improve. You also know at the same time, Spain, United Kingdom, Italy, and so forth has been impacted outside of China. And so we're monitoring it as we speak. But we think that hopefully our base case is that if they had to learn anything from China, then hopefully the number of new cases will start to taper off, hopefully by the early part of May, if not the end of May. And so where do we go from here? Next slide. So the lessons learned in China in terms of this recovery, right, is that obviously they impose strict social distancing, right, similar to what Malaysia is doing, and that's been very, very effective. You get some sense that the government has actually started to ramp up its spending to revive its economy by close to 2.8 trillion. This is actually not a lot compared to what it did in 2008. I'll talk a little bit about later on what they will be doing in the future. They've also started to stimulate the economy through interest rate cuts, and therefore basically trying to stimulate, make sure that the economy does not tank too fast, right? And also they have started to do a lot of SRR cuts, basically injecting liquidity into the market. What this all means is that they have done a lot, right? And so the next question is, what's next? Next slide. So what has really happened is that because of all these measures that have been implemented, and this is a very interesting chart that shows you the kind of recovery that you're seeing in China today, right? Obviously, in the month of January and February were very, very sharp deterioration in terms of growth. You can see that on the blue chart here. That's the Caixin China Manufacturing Index, and that has started to improve above the 50 level. Above the 50 level basically shows expansion. Now, this is only, I want to caution you that this is only a 1 month data, and therefore we shouldn't read too much into it. But anecdotally, as we speak, and we've done enough channel checks in China itself, we're starting to see some form of normalization in terms of back to work kind of scenario. And the next slide will show you this. Next slide, please. You can see here how China has rebounded in the month of March, right? And so if you draw your attention here to the overall in terms of consumer spending, right? And the right-hand chart, purple chart here, or the blue chart will tell you after 7 or 8 weeks what's really happened. So you've seen consumption started to improve, particularly in online spending. So as you know, China is a big online community out there. Hotel business has started to resume a little bit, but obviously the restaurant business has not improved that much, as well as auto sales. But property sales has actually rebounded. And so what we are seeing here overall is that consumption, ex-auto and travel, is back to 85% of normal levels. And obviously the large ticket items is still below the average, and that's quite normal. And so what we are saying here is that because of the measures that are put in place, things are starting to improve in China, and we're hopeful that this trend will continue in the months to come. Next slide. So where we go from here is that I think the Chinese government is monitoring the consumption patterns in China very, very carefully. Sorry, can you mute your phones, please? Yeah. So overall, what we are saying here is that the China government has basically employed certain amount of fiscal action, but not in a massive way compared to its counterparts in US as well as Europe. And I think the point I'm trying to make here is a very good one, because what it means that it is saving its bullets in the eventuality that you do get a second wave. Next slide. And what do we mean by the second wave? Right. So before we get to the second wave, this is the kind of China policy timeline. It has contained, it has its measures, and it has restored production. And I think over the months to come or the weeks to come, it is monitoring what I call whether or not the second wave will happen. If it doesn't, they will look at exports. As you know, they are the factory of the world, and therefore they export a lot of their goods to the US and to Europe and the rest of Southeast Asia as well. And I think they're monitoring it very carefully. I think this is a very key important point to note, right? Despite the fact that consumption is rebounding, we need to monitor this very, very carefully, because if demand will start to get softer, especially export demand, then they will use their joker card called fiscal stimulus, similar to what they did in 2009. Just to recap, in 2009 or later part of 2008 to be exact, China basically saved the world, right? They implemented 2 trillion renminbi, which is equivalent to today's money of about 585 billion US dollars in what at that time was considered as a China bazooka. And they went out there and spent a lot of money in terms of supporting consumption and supporting infrastructure spending. And what really happened after that was the building of, from the east to the west of, you can think of numerous numbers of high-speed rails, a lot of infrastructure buildings and so forth, to make sure that the economy keeps going. I don't think this time round the stimulus will be as large as we anticipate. I think this time round the stimulus will be more measured, whereby I think they will look into unemployment. My sense is, talking to a lot of economists in China, is that I think they will be very, very measured in making sure that unemployment does not go too high. And basically what we are saying here is that I think this time round the fiscal spending will be very, very targeted to making sure the unemployment does not rise. But the other point is that even though they want to spend on fiscal infrastructure, they are going to spend for the future. And I'll talk a bit about the what's next in the future of China a little bit later. But to give you a little bit of heads up, if you were to see what China has done over the last decade, since 2009 to where it was in 2019, it was the era of technology. It was the era of the Tencents and the Alibabas of this world. It was the era of the WeChats taking over, basically using cash when you pay for your goods or your groceries in China. It was the Industrial Revolution 4.0 of the world that we've never seen in the last 40 or 50 years in China. This is the Industrial Revolution that China has taken on, and it will continue to take on. And I think even despite COVID-19 happening today, it will continue to spend in a wise manner, support its growth, but also building for the future. And I think that is the key point that you need to think about when you invest in China. China is not going to sit still. It doesn't really care what the US is thinking. It will continue to basically build and progress for the future. Next slide. And so I've alluded to all this in terms of policy making. I don't want to talk too much about that, but I think the key point here is the monetary support that I mentioned earlier on government spending on the right-hand side here, and also what kind of policy measures that we'll think about from the short-term and long-term policies, right? And obviously, at the end of the day, I don't think they're also sitting still in terms of just innovating in terms of R&D and so forth, just for technology. But I also think that they are also going to start thinking about the vaccine on how you can avoid another pandemic like this in the future. So where do we go from here in China, given the fact that where we are today? Next slide, please. Where do we see China today is that obviously in the first 2 quarters, you may get a dip in what they call recession. But having said all this, we've compiled the growth across Southeast Asia. We think that the US will go into a very deep recession in the first 2 quarters as well. We may see a full negative 2% in US, but in China itself, we may see actually growth decelerating quite sharply, but rebounding in the second half, potentially growing at about 2 to 3% only in China, where it used to grow between 5.5% to 6.5% previously. Obviously, as I mentioned early on, the key thing to watch out for is unemployment rates in China, where I think there will be still people who are impacted by the COVID-19. The government in China obviously is very, very careful about managing unemployment rates. I think the mantra or the message that I'm getting from the government in China is that they don't want unemployment rates to rise too dramatically. So next slide. So where do we go from here in China? Where is the next stage of the growth drivers of China? I want to spend a bit more time about this because I think it's very important for investors like yourselves, including myself, to know where China is, not just for today, but for the future. And so I wanted to share with you this next slide, which I think is a very important slide for all of us to understand where China was before and where China will be, right? And this is a very quick snapshot of the history of China over the last 3 decades. So if you recall, in the 90s up until 2008, on the left-hand side here, basically China was the export engine or the manufacturing engine of the world, right? So they started off building a lot of cheap toys and furniture, garments, and so forth, right? I think the world has changed since then, right? It's post, as I mentioned early on during the GFC, global financial crisis. And what they did was to move on the lower quadrant here, where they started to focus on domestic-driven economy, which is basically consumption, and also the Internet of Things and services. I think in the next decade or so, 2019, as I mentioned early on, the concentration of the emphasis of China will be focused on what I call the infrastructure of things, the technology of things, right? And I think that this is a very new environment where China wants to continue to build the platform on. For example, I was in China early part of this year in January, right? And I go there every other year, at least twice a year, right? And my observation of China this time around was that they did not really think that they were going to slow down. They did not think that just because Huawei was going to be implicated by the US, that they will slow down, right? They are going to build and be the champion of 5G. They want to be the software engineers of the world and take over from India. They basically want to build the next platform of growth in China. And I think if you look at their history, and when they say go, they will go. And that's the beauty of China. Whether we like it or not, China is going to implement the Internet of Things, the software engineers of the world, the artificial intelligence of the world. And you and I know that they are already one of the top artificial intelligence companies in the world, the Sense Times of this world and so forth. And so I think this where innovation-driven and consumption-driven will continue to be the biggest drivers of the economy. And so as investors, especially the ones who invest in the A-share market, this is where the paradigm change of the A-share market will continue, and I think it will be for the future. And I think the next slide will show you, next slide, how the evolution of China has been. You can see here on the left-hand side here, we used to use a lot of money. Today, we use a lot of WeChats to pay a lot of our groceries and so forth. China was basically a bicycle economy. Today, it is one of the biggest and largest EV vehicle centers of the world. When I talk to a lot of auto manufacturers today in China, all they talk about is EV. They don't even want to talk about the normal kind of cars that we use every other day. And so the manufacturers today are continuing to build more and more sophisticated batteries to sustain the EV culture. As you know, transportation has evolved in China, being high-speed rails and so forth. I had the privilege to take a high-speed rail the other day in Shanghai to the airport. It was a very exhilarating experience where you only take about close to 12 minutes to get to the same distance that we have between KL Central and KLIA, actually. So the evolution of China continues, and I think this will be an exciting era of China. Next slide. I wanted to share with you this very interesting observation that we have, and that is the Chinese millennials. And I think this is where the consumption-driven economy and the Internet of Things will continue, right? Just to give you some numbers, there are about 415 consumers in China today, a big amount. 92% of the users in China are millennials. And we all know this, right? A lot of these guys are very smart. They all go to colleges, they go travel overseas, right? But do you know that, the joke we have as investors is that, in China, the average millennial will have 5 homes or houses when they inherit their parents' money. They have 2 from their parents and 2 from their in-laws, right? The quick question is, when you divide by 5, you divide by 2 or divide by 1, right? But anyway, jokes aside, the thing here is that they have a lot of capacity to spend because the wealth that has been built up over the years has been tremendous. So as you know, we partner CCB Principal in China, right? And Principal basically, we have a partnership, JV partnership in China. We own about 25% share in that fund. And we have a bunch of very clever analysts down there, right? And I was speaking to one of the analysts the other day about, where they see, right? And this guy is a very rocket scientist guy who manages our CDOR fund, by the way. And he basically talked to me about his net wealth, right? He stays in Beijing, and his house is worth twice my house, right? In Beijing, he only owns a 800 square feet apartment, but that particular apartment is worth about 10 million renminbi, okay? That's one house he owns. He is going to inherit maybe another one. That's Beijing for you. Now, if you extrapolate this across, let's say, 415 million millennials out there, how much wealth do you think they have? A lot of money, right? So my point here is that the ability to consume at 14% growth per year, notwithstanding the COVID issue that we have, right, will be tremendous over the future. And their spending habits will not just be confined to luxury goods, to holidays and so forth. These people are going to get more and more sophisticated in the way they go about it. Online shopping, as you know, is already a big thing, right? Who knows? They will probably be buying cars online. They'll be buying already insurance online. They'll be buying basic consumers and all that. And maybe they will be looking for their girlfriends online as well, right? So the point here is that they will continue to use the internet and basically consume, right? And so I think this is where something we need to watch out for. I don't think it's priced in by the markets yet, but I think this is where the future is. Next. We'll talk about this is the more global view on generation of millennials, but I don't want to spend too much time. But next. Yes, so I wanted to also share with our investors the long-term, very ambitious plan by the Chinese government. And this is called the Greater Bay Area. As you probably know or don't know, the Greater Bay Area is going to be similar to rival the San Francisco Bay Area, the Tokyo Bay Area, and potentially even the Silicon Valleys of this world, right? And I think this is where I think China is starting to think beyond the COVID-19 issue. In fact, they have already mentioned many times that they want to change Hong Kong and develop Hong Kong to the Greater Bay Area, right? And it is estimated that the Greater Bay Area's GDP by 2030, in 10 years' time, will triple to 4.6 trillion US dollars. If you recall what happened to San Francisco as well as the Silicon Valley in the last 2 decades, when Apples of this world and all that started to shift a lot of the manufacturing hubs to the Silicon Valley, right? The whole San Francisco Bay boomed. Today, San Francisco Bay is one of the most richest areas in the US. Unfortunately, it has a very huge amount of very poor people there. I was there about a year ago, and you can sense the big divide between the rich and the poor. I'm not saying that the Greater Bay Area will be like that because that's China for you. But what I'm trying to say here is that the opportunities in Greater Bay Area are forthcoming, right? Let's move on to the next slide. This is where we get very excited when we talk about planning by the Chinese government, right? And this slide here gives you a sense of where we think the Greater Bay Area could be in the next decade. So you can see here on the slides where we started to see where San Francisco Bay was and the Tokyo Bay was, right? And in the future, we are going to see the Greater Bay Area being much bigger than the San Francisco Bays of this world or the New York Bays of this world, right? And I think you don't have to wait that long. Maybe you wait another 5 years. The GDP is actually forecasted to be about 2.5 trillion. In the next decade, it will be close to about 3 trillion, right? So a doubling impact from where we are today, about 1.6 trillion, that's about 2018. So I think if you are a long-term investor like ourselves, and you like to invest in companies which are innovative, in Guangzhou as well as in Zhuhai, where it is epicenter, as well as in Shenzhen, which is epicenter of technology in China, I think this is a very good opportunity. By the way, we have launched a Greater Bay Fund at the end of last year. If you have one more information, we have our salespeople on board and also IFAS to give you some more information about the Greater Bay Area to give you some sense of where we see the opportunities are. Next. Okay, you can't talk about China without talking about the market where we see the greatest opportunity in the world today, right? One of the things I get excited about when I talk about China is the fact that China today, on a relative value basis, is offering you a lot of value, right? So you can see here on this chart here, basically the comparison of China market versus the US market, the European market, the Asia and Japan, right? China A obviously is trading at 11 times. To me, it's very cheap relative to, for example, the US, which is trading about 15 times. By the way, this is after the adjustment or the correction that we had, right? And so, and the other point I want to make here is that despite the fact that it's cheap, it has also been very resilient. One of the key reasons why the China-Asia market has been very resilient this time round compared to the last round when it got sold off in 2015 and 16 is a major structural issue, or not a real issue, actually it's a good problem to have, is this. Next slide, please. This is where I think a lot of investors need to think about when you're a long-term investor, right? Today, right, China, from a GDP perspective, accounts for 16.9% of total GDP. But the foreign ownership of this market is only less than 3%. So all the global investors of this world have concentrated a lot of their money still in the US market. So when you talk about MSCI World Index, guess what? The biggest portion of that index, 50% to be exact or more, is still in the US market, right? Obviously, because it is more liquid. But I also think it is not just about liquidity. It is also a function because people are still very reluctant to invest in the Asia or China market because people are not so sure whether or not the Asia market is going to be as big or as credible as the US market. I think as an early investor like ourselves, we should get involved in the A share or the H share market very early, especially when there are structural, as I mentioned earlier on, structural positives to the market. Next slide, please. You can see here on this chart, and this is one of my favorite charts if you're a long-term investor, right? So I've been looking at China very actively over the last decade, right, since 2010. My boss Munira is on the line, and she basically caused me to lose all my hair because I started to look at China, right, for good reasons. We started a fund called China, India, Indonesia Fund, and we sold it to our Japanese clients at that time. And when you fast forward one more decade later, I'm looking at China almost on a daily basis, right? And today, where we are today in China Air is 0.8% on the market only. We project at the end of 2019, we about 3.9 in terms of inclusion. And when the MSCI were to include it more, we think this will be 17%. What this really means in layman terms is this. It means that there are a lot of interest coming into the China market. As we speak, I was just talking to UBS yesterday, which is one of the largest A-share brokers in China. And basically, they're selling that there are basically a lot more inflows this year than they've ever seen, and they're taking advantage of the current weakness in the market to invest. And I think MSCI has basically given us that if you were to increase the A-share inclusion by more than 5% to total inclusion, you will get the total index in MSCI emerging market by 17%, which means people are now starting to think about relative value as we are looking at to shift away from the US market, which is actually more volatile today, to the China A-share market as well as the H-share market. And so one of the reasons why the A-share market today is a little bit more resilient is based on this factor. And I think you need to start thinking about this as long-term investors if you want to think about how you want to allocate your funds into the A-share or the H-share market. Next slide. And so, as I mentioned early on, overseas investors offshore has increased by the trillions of dollars through what we call the Stock and Bond Connect. And I think this is in line with our view where MSCI Emerging Market Index rebalance will continue. Next. This is our Asia. So obviously you want to know about the outlook of the markets in Asia and how that is represented in China. Just to give a view for those of you who are invested in our Asia Pacific portfolios. We continue to like China, Korea, Taiwan, Singapore, mostly all the North Asian markets, which we think we have continued growth, and we continue to see a lot of innovation in these markets. I think our view here is that we may see a dip in the first 2 quarters in terms of growth, but we do see a resumption of growth by the 3rd or 4th quarter of this year. And obviously in that portfolio itself, we continue to like the Greater China area, especially China, Korea, Taiwan, as well as Singapore. But more importantly, for those of you who have invested in our China funds, for example, let me give you some heads up on how we see China today. Next slide. We do see a major drop in terms of growth in China in the 1st quarter as well as the 2nd quarter. But we do see a lot of opportunities, particularly when we see the resumption in PMI numbers rebounding, especially in opportunities like the high-tech sector, like 5G, consumption services and so forth, as well as the media, gaming, online. And we also see pockets of opportunity, for example, in infrastructure spending, as I mentioned early on, in the Internet of Things, especially intelligence infrastructure, as I mentioned early on, which is the big growth drive area for the Chinese government in the future. Next. So in my concluding remarks, I just want to say that I think when you start looking at China, you cannot look at it in isolation in your personal portfolios. My belief is that China is a very important basket of portfolios that you need to start looking into, but at the same time, you also need to look at your risk. China is without a market which is high growth, it also has its risk. So you need to speak to your personal planners or ourselves to get a sense of how risky it could be. Our view is that basically at the end of the day, we have basically 3 different types of funds for you to invest in. If you want to diversify in China, we have a Greater China Fund, which includes Taiwan, Hong Kong, and the Chinese market. We have a more sophisticated, higher risk fund called the China Opportunity Fund, which are more small cap in nature, which obviously has more volatility, but it's very much so focused on customers who understand China a little bit more. And obviously, for those who are a little bit more longer term, we also want you to diversify, as I mentioned early on, to the areas like the Greater Bay Area, which we think are much more higher growth or more long-term in nature, where you need to be a bit more patient, but you need to see those kind of diversification strategies working out more than 3 to 5 years down the road. So all in, so this is basically how we look at risk. Obviously, China A and H is what we call slightly mildly aggressive funds, and in the more emerging market kind of equities on the right-hand side of the corner here. So if you fit that bill, please continue to support us and buy into those funds. And you can see that over the last year to date itself, China continues to be very, very resilient, and I think we will continue to be that case. And I think it's rebounding as we speak. And so I think this is a very good opportunity for investors who are not invested in the H or the Asia market to come in at this juncture. Next. This is a long-term chart of China over the last 20 years. If you're invested in this, I always like this chart, and I think about, I wished I invested in China much earlier, especially after the GFC area, where the Tencents of this world went up by more than 10 to 12 times to $1. And so that is the opportunity set in China, where if you get in early enough, dollar cost average, and you know your risk, you can make quite a fair bit of money over the longer term. Next. So in conclusion, I also want to make this parting remark, and that is, this slide is self-explanatory, but I cannot emphasize more that you need to know your risk when you invest in China. There are a lot of opportunities in China today, especially in an environment where we think that COVID-19 is well contained. Secondly, I think the government is on the forefront in terms of its initiatives towards stimulating the economy. Although there will be a dip in the first quarter, we think there will be resumption in the second half, and we're hopeful that in the future, they will continue to innovate and basically transform the economy that they had before in the last decade. And I'm very, very positive that this trend will continue. And I basically wish you all the best. And if you have any more questions, please, we can move on to the next slide session where we can do a Q&A. Thank you very much for your time, and I appreciate your time today. And we look forward to more of these kind of webinars in the future. Thank you very much.
Thank you so much, Patrick. Ladies and gentlemen, we will now resume the chat session. So we'll take some questions. Okay, we have one here from an attendee. So what is your recommended approach to re-enter into the market now? Hold and monitor further, or what's the next action?
It depends here, as I said earlier on, right, what your risk appetite is. Obviously, we always recommend that you need to have a plan, and basically you need to know what your needs are, right? If you're talking specifically for China funds today, I think the market is cheap. I think the market obviously has seen its worst in the January-February times. And I think that if you do believe that the kind of growth that we're talking about in the future, then obviously do go out there and dollar cost average if you haven't. If you're a new investor, firstly, think about starting off maybe not in a small cap fund like the CDOF, maybe start off with a Greater China Fund, and then maybe if you're a little bit more longer term like myself and you want to invest for your children, think about a Greater Bay Fund.
Okay, thanks, Patrick. Okay, moving on to the next question. Okay, I think this attendee is asking about hedge funds, because he's asking, should we be getting AUD, SGD, or MYR hedged? What's the difference?
Sorry, what's the question again?
I think it's about hedging, funds hedging. I'm not sure if it's referring to the funds that are AUD, SGD, or MYR hedged. But he's asking what's the difference between these three currencies.
Yeah, so I suppose it depends on whether you want to take, so if you buy a typical ringgit-based fund and you want exposure to the China market, right? To be fair, right, I think, you know, you do take currency risks as you go along, right? But the currency in ringgit versus renminbi is quite correlated, right? So renminbi goes down, ringgit will go down, right? So you're not going to really get a hit unless you go and buy a dollar asset class. And I would recommend you to buy a dollar asset class as long as you think that the dollar will continue to be up, right? I don't really have a very strong view of where the dollar is. The dollar continues to be fairly strong, but that's basically because in an environment where there's a lot of uncertainty, usually the dollar will continue to rise. I don't know how long this sustainability of this dollar rally will continue. My view is that I think at some point the dollar will start to correct, and in that kind of environment, you typically want to invest in emerging markets like China. So if you're willing to take a currency risk, and then basically just go and buy a ringgit hedge class.
Okay, another question. Many of the opportunities that you mentioned are long-term in nature. When do you think the China stock market will re-rate upwards in terms of timing-wise?
I don't want to profess about timing because timing is a very tricky issue. But let me give you some perspectives of when you invest when there's always going to be a major sell-off, right? Think about the days in January, very short term, right? I myself, I've invested in China funds. I invest in my own funds, right? And if you invested in the days in January when the stock market basically came down because of the COVID-19 initial stages, in some of our funds, if you bought at a low, you'll be up by maybe 10 to 15%. I'm not saying that all funds will be like that, right, in the short term. But generally speaking, I wouldn't advocate you to go out there and go and time the market too much. I would suggest you go out there and dollar cost average as in when you see the weaknesses in the market happens. As we stand, the markets are starting to rebound, especially in the US, right? And so the China market has started to go up yesterday and the day before by more than 2%. And so I think our view here is that the markets will start to appreciate that as long as COVID-19 globally is well contained in the months to come, I think we're going to see a resumption in the equity rally. I think it's starting to already happen in the developed markets like US. I think it will continue to happen in the Chinese market as well, as both on the hedge or the A-share market. So I don't think you should time it too much. I think you should start to think about investing now, and maybe if it does correct even more, and putting more money to work, right? And so what we are seeing in terms of flows is that a lot, as I said earlier on, a lot of the global portfolio managers are putting already money to work, shifting a little bit away from the US market, which is a bit more volatile and uncertain, to markets where they think will continue to be a little more resilient, like China.
Okay, another question. Between H shares and A shares, which has more opportunity and why?
Well, both are good, right? I think basically H share, as you know, are basically Chinese companies listed on the A-share on the Hong Kong market, on the Hang Seng, and obviously the A-share market. A-share is basically stocks which are listed on the Shenzhen Stock Exchange as well as the Shanghai Hang Seng. What is the major difference? The major difference is that most of the larger companies, which are a little bit more well established, for example, this world, the Meituans of this world, and all that, the HSBC of this world, we have operations in China, the AIAs and all that are listed on basically the Hong Kong bus, right? And then when you think about the A-share market, you have basically the CSI 300, CSI 500. Without taking into technology, basically, my belief is that you believe in growth like me in the future, you should start thinking about investing in the A-share market. Obviously, by investing in high growth areas, the volatility of the fund is much higher, like our CDOF, right? But whereas if you were to invest in a typical HA market, the volatility of the fund will generally be much lower. But there is no, basically in economic terms or financial terms, there isn't a free lunch. You want to take risks, obviously you will hopefully be compensated by higher returns. If you do not want to take too much risk, then obviously think about the HA market. Valuation is only one way of looking at the markets. You also need to know your risk profile. You need also to know what you're into, right? So when a lot of investors come out and ask me, is the A-share market for you or me? Well, I don't know your risk profile, but for every dollar that you have, maybe you put 10 to 15 cents to a dollar to the A-share or H-share market, because that is where the growth will be, right? And then put into something else into the other markets that we like as well in APAC.
Okay, I'm not sure, Patrick, but do you have a point of view on healthcare sector?
Healthcare in China or healthcare globally?
Didn't mention, but it says it seems like during this pandemic period, the healthcare sector fund is going downward. Shouldn't it be going upwards or positive instead? This is the question from the attendee.
Right. Okay. Well, it depends, right? So in healthcare, there is many subsectors of healthcare, right? So you've got the hospital businesses, you've got the pharmaceutical businesses, and you've got the people who develop vaccines, for example. Obviously, the guys who are developing the vaccines will do very well. Like for example, the glove makers in Malaysia are one of the best performing sectors in the market today, obviously, because as COVID-19 explodes across the world and it becomes a pandemic, obviously the need for gloves increases. The hospital business is a bit more complicated because a lot of these companies which are listed are private listed companies. And a lot of people need to have insurance or are a little bit more expensive, for example, to go into private healthcare. So we haven't seen the numbers. So maybe that's one of the reasons why the healthcare sector has not done so well. But overall, as a sector, we continue to like it, obviously, in this kind of very pandemic era, especially in Malaysia, for example. But globally, I can't comment too much about pharmaceutical as we speak, because there's a lot of more moving parts to it. Like I said, the different subsegments of the industry.
Okay. Do you foresee any stress in China's corporate balance sheet, despite supply network has normalized, but aggregate external demand slumps and tighten foreign currency liquidity?
Yeah, that's a very good question. Right. Okay. So there's a lot of talk about China debt rising. It's going to cause a systematic risk to the economy, and in eventuality, if the export market collapses or consumption collapses, then what happens to the Chinese economy? Now, I've been hearing this for almost 10 years, right, to be honest. And if you ask my fixed team and my equity team itself, we are monitoring this very carefully. But I get the sense that the risk is there, but a lot of these debt that they have accumulated over the years are localized debt, which means if it's a localized debt, they can control it better. They will basically, how they can control it better is because the PBOC, which is basically the Bank Negara of China and the authorities there, right, will use whatever means they have and the reserves they have to inject liquidity to make sure that the financial issues that they have in terms of lack of liquidity or potential stress in the economy may not happen. Since COVID started in January to now, they have been structurally, very cleverly injecting lots and lots of liquidity into the market. And I think that has smoothened out any form of acute risk to the market. And so we get comfort of that. If you think about the kind of stress that we talk about in China, I think it'll be well contained. Obviously, it's still early days, but so far we haven't seen any major upsets in terms of credit quality in China. I think the risk could be much higher, to be honest, in the US rather than China at the moment.
Okay, there's one interesting question. How reliable do you think is the data released by the Chinese government? And what's the risk if investors are being blindsided, by unreliable indicators?
Sorry, I didn't get your question.
How reliable is the data released by the Chinese government? And what's the risk if investors, are being blindsided by the real?
I think China, from my observation, has evolved over the last incrementally a lot over the last 5 years, right? In terms of its openness to corporate governance, its openness to its own books, and so forth. Obviously, there's always been the risk that corporate governance has been an issue before investing in onshore Asia market, but of late, because of the movement towards opening up its economy and its financial market, don't forget, I didn't mention early on, the Chinese government also has a very ambitious agenda, and that agenda is to internationalize the renminbi. And by international renminbi, they want to see the bond market evolving even bigger than it is today. It is potentially the largest bond market in the world today. It is the second largest stock market in the world today. It is their view eventually to be the biggest stock market in the world. And if you want to be the biggest stock market in the world, and you want to attract more money like myself and the rest of the world, you need to be able to open up. And so what they have done is they started a committee for the last 2 years to make sure that the kind of corporate culture that we have needs to be improved in the Asian market. Obviously, it's come from a very, very low base. It's starting to rise. And I think over time, this will start to improve. Obviously, you hear a lot of noise now about corporate governance issues and so forth. But I think it's still very well contained to the number of companies that we have in China today. Don't mistake, right? Obviously, investing in the Asian market has its risk, but I think in terms of the corporate governance issues that we are talking about, it's much, much better than we were about 5 years ago. I think we are on in an improving culture. Think about it this way, right? My analogy is this, right? When I first started my career about 30 years ago, 27 years ago, right? Malaysia was a big emerging market where nobody talks about corporate governance. Today, 27 years later, right, we've become more or less a very boring market, as you call it, a very defensive market. Why? Because the government learned from 1998, the government learned from 2008 to make sure that corporate governance becomes a very big issue. Today, Malaysia is the center of what we call a lot of corporate governance centers of the world, right? And so if you think about that as an analogy and think about fast forward to China, which is a big economy, big market and all that, right? What do you think the Chinese government is going to do? They will make sure that if there is any fraudulent impact to the companies, especially on the CSI 300 or CSI 500, which they want to sell to the rest of the world, then obviously they need to improve corporate governance. So I think the risk is already starting to decrease. And I think the opportunities for us in terms of liquidity, in terms of the kind of growth companies that we invest in, will continue to rise over the future.
Okay, one question. It's a fund-specific question. So principal direct opportunities is invested in small and mid A-cap shares. So the question is, why is the portfolio invested in almost 500 companies? How can the fund manager manage the fund and conduct analysis and all that?
Okay, this particular fund, which is basically advised by my colleagues in China, when we first started this fund basically is an enhanced index fund, right? What it really means is that they use quantitative tools to basically manage the fund. And they believe that the quantitative method of managing the fund can enhance the value of the fund, right? And so what they do with this particular fund is they don't just use analytical tools to invest into the stocks that they invest in, but they use basically big data and so forth to basically become making sure that the fund basically outperforms the benchmark. And so in a typical enhanced index fund, what you do is that about 70–80% of the fund basically is using quantitative tools, and the rest of it is using what we call qualitative tools to invest into the funds, right? And so that's what it is. And so that's the main reason why, as a quant fund itself, basically you need to have about 500 funds. the beauty about having a lot more stocks in the fund, it becomes more diversified, especially when you're investing in small mid-cap companies in China, right? To mitigate any form of risk that you think about, right? And so I think we are probably we won an award for this fund, as you know, and we continue to use technology as one of the tools to invest, as we think that, especially like big data and so forth, it's how we should be investing for the future.
Okay, another question. The US has already started and will continue to undermine China's ascendancy, I think controlling influence. So how will this impact China's growth moving forward?
The short answer to that is I don't think it will, right? I think at the moment it is a truce in terms of the China-US trade war. I think, as you know, the China-US trade war happened because US was using that as a political tool to undermine China. But more importantly, I think there has been a fear factor in terms of its prowess or its growing influence in terms of technology. And as I mentioned earlier on, China is not going to sit still. I don't think it's going to slow down. I don't think the Huawei case is going to step it back from where. I think it will just delay the ascendancy of China. And I think it will take a more measured way in terms of how they want to go about it in a more clever manner. What I call the stealth mentality, where they don't have to tell you a lot of things until it happens. And so I think that kind of the analogy will continue. Like I said early on, my sense is that they are not stopping. They are continuing to develop 5G, and they're already planning for the next 10 years.
Okay, we will take one final question. So this client, he has invested in some principal funds. Okay, they are more Malaysia focused, which are underperforming for quite some time, even before the COVID-19. Should he cut losses and switch to China-based funds now?
All right, okay, yes, that's a very typical question that we always get. I think at the end of the day, you must put things in perspective when you invest in a Malaysian fund versus a China fund. The risk profile is very different. So that's key point number one. Number two, obviously over the last 3 to 5 years, as you know, the Malaysian economy and the market has not been doing too well for obvious reasons, right? The economy has slowed down, the structural issues in politics and so forth, right? And China or Asia Pac portfolios, for example, have started to outperform, mainly because of China. And so if you want to think about cutting losses, you must also understand that you must also think about that you cannot have a silver bullet that when you invest in, you're going to get back all your losses in 1 day or 1 month or 1 year, right? You've got to be patient as well, right? Where we see Malaysia today, Malaysia is pretty bombed out, right? It's been hit on all fronts. It's hit by oil, it's hit by political risk, valuation are cheap. All the signs are showing that basically Malaysia should start to bottom out. Obviously, value is value and it gets cheaper and cheaper sometimes, right? But I also think that it is also a market which offers you dividend yield. It is also very, very defensive. The volatility of our Malaysian funds are much lower volatility compared to a China fund. So you need to put those things into perspective when you start to think about asset allocation. Now, I don't think it is not an unwise decision to basically start to reallocate to China, but I don't think you should start putting all your eggs in one basket and one go as well, right? So I think you need to have a conversation with your personal planner or somebody within our sales team, for example, to understand where your risks are and where your opportunity set is, because I can't comment on that on this webinar because I don't know what your time horizon is, what your needs are, and so forth, right? But to be fair, I think it makes sense if you're more longer term and you want to diversify away towards a more growth-oriented country like China or Asia Pac, for example. We have a lot of funds that caters to it, whether it's income funds, whether it's a growth fund, and so forth, right?
Okay, thanks so much, Patrick. I think we will end the Q&A session here. Ladies and gentlemen, for some of your questions that we did not answer, so please, you can feel free to drop an email to our investhelp.my@pansukomat.com. Our client investment specialist team will be able to answer some of your questions. And there are also clients who are experiencing audio issue. No worries. Also, please drop an email to investhelp.my@pansukomat.com, and we will actually send you the webinar recording. Okay, so I would just like to bring your attention to a campaign. Okay, a campaign that we will be running with Principal Asset Management, sponsored by Principal Asset Management, is the EPF I Invest campaign. So basically, for this campaign, for the first 10 investors who invest in EPF approved principal funds with FSM1 through EPF I Invest. So these first 10 investors will win 30 ringgit touch and go reload pin. So how do you participate? So basically, you log into your EPFI account. Okay, you select principal and you select principal EPF approved funds that you prefer. After that, you click buy under iFast Capital to complete your transaction. Okay, how are you qualified? Is that you need to take a screenshot. Okay, you need to take a screenshot of the transaction completed page. Okay, of the transaction completed page. And then you can email it to investhelp.my with your name, full name as per NRIC, and also your mobile number. Okay, so this campaign period starts tomorrow, 9 April, and will end on 10 April 2020 by 12 p.m. And only transactions dated 9 April or 10 April will be taken into account. And we will announce the 10 winners on our Pansukomat Facebook page. We will also try to announce it in the event page as well. Okay, for those who are wondering what is this screenshot of the transaction completed page, it is actually, this is the page. Okay, I'll screenshot it. So you can see the transaction completed word and your purchase order number. Okay, so you print screen this page and then you send it to investhelp.my, and you will, based on the first 10 investors, by email timestamp. Okay, so with that said, I think that would be all. I would like to take this opportunity to thank Principal Asset Management and also to thank Patrick for taking the time to come over here to actually present on China. And ladies and gentlemen, if you have any questions, feel free to email to investhelp.my@pansukomat.com. And also, we will have a webinar tomorrow at 4 p.m. with our in-house research team, so stay tuned for that. Thank you, everyone, and see you tomorrow.
Thanks very much, everyone. And on behalf of Principal Asset Management, I'd like to thank iFast and the rest of the people who have joined. I'm very, very honored to be here, and our sales team is always happy to serve your needs. So please do call us or send us some messages to our salespeople or iFast to let us know what your queries are, and we'll be happy to entertain you. Thank you very much.